Hey guys, it is Mrs. Lamphere. We are now looking at Unit 3, Section 4 of our accounting curriculum. So we've been talking about recording business transactions, and so far we've been classifying things as assets, liabilities, and owner's equity accounts. Okay, and so that's kind of like a tip of the iceberg type of transaction. So now we're going to introduce some more accounts. First, let's kind of review. So assets, we said, were things that we own for our business, like office equipment, supplies, furniture, cash. Those are all assets, and we have accounts for those different assets. Liabilities, we said then, were things that we own, the money that we still owe on different things. So if we bought some things on account or on credit from other stores, then we have an accounts payable to each of those different stores that we still owe money to. So those are our liabilities, or what we still owe. And then we said owner's equity was the monetary value of what we own. So like basically the monetary value of our business, or the dollars that our business is actually worth. Okay, and we discussed that was that the owner's capital account was part of our owner's equity. So now we're going to introduce a few more accounts to you. We're going to look at transactions that are related to a revenue account, an expense account, and the owner's withdrawal account. So get ready to learn about a few more different accounts. Okay, first of all, let's talk about temporary and permanent accounts. So a temporary account is an account that's going to start with a zero balance every accounting year. So all of these, the revenue, these expenses, and the withdrawal accounts that we're going to talk about, those are all temporary accounts. So they're going to close at the end of each fiscal year. And here's a fun fact for you. The term fiscal year, all that means is accounting year. So when you talk about a business's fiscal year, they're talking about, okay, the period of 12 months that you've been tracking your finances, that is the fiscal year for a business. So it's not necessarily January through December. A lot of businesses actually run their fiscal year July through June. So just kind of a fun fact. You don't really need to know that for anything in this class, but just something you should be aware of. Okay, so then permanent accounts. Permanent accounts are an account that has a continuous, it's a continuous account that is maintained from one accounting year to the next. So what that means is these account balances are going to carry over into the next fiscal year. So our fixed assets, liabilities, and owner's capital accounts. So the accounts that we've been working with, those account balances are going to transfer over into the next fiscal year. So for instance, if a company purchased plant equipment, so big machines to operate their business, for $3,000 during the year, this transaction is recorded in the plant equipment account, which is a fixed asset account. So we're looking at fixed assets, which we said fixed assets were those assets that were going to last us a long time. Okay, like more than a year. There were those non-fixed assets that we said we would be using up in a year, like office supplies and cash, but fixed assets are a permanent account that will last us more than a year. Okay, so back to this example. This transaction is recorded in the plant equipment account. At the end of the year, the account has a debit balance of $3,000 as its ending balance. This balance is carried over into the next accounting year as the beginning balance. So think of it just like you have a checking account, and you have a $500 balance in your checking account, and you come to the end of December, and that balance is just going to carry on into January for the new year. That's how it's going to work for permanent accounts in accounting as well. Okay, So not a lot of new information. So far we just kind of threw in the fact that there are going to be temporary accounts. So accounts that zero out or close after every accounting year. And we'll get more specific on how to close out those accounts. But just know that there are temporary accounts and they will close at the end of every fiscal year. And then there are also permanent accounts. So these are accounts that will carry their ending balance over to the beginning of the next accounting year. Okay, so not too crazy. But so let's get back to those revenue, expense, and withdrawal accounts that we were just talking about. So when looking at a revenue account, this is how a T account is set up for a revenue account. So before we mentioned assets, liabilities, owner's equity, each of those T accounts are set up a little differently. You'll probably recognize that this revenue account is set up a lot like the liability and owner's equity type of T account setup, where we're decreasing on the debit side and increasing on the credit side. So, and I'm going to show you a big umbrella picture of what all this looks like here, but I'm just kind of breaking it down for you at first. So a revenue account is set up to maintain a record of the business's income. The debit and credit rules for a revenue account are we increase on the credit side, decrease on the debit side, and then the balance, again, is always recorded on the increase side. So the balance is going to be on the credit side of the account, just like in our liability and owner's equity. Okay, here's an example of a revenue account. So say we have a university that collects fees for students for like books, tuition, whatever. So this would be a university's fee account, which is their revenue account. Okay, so let's say they collected $50,000 in tuition fees from students. So we're increasing on our credit side because we collected that from students. We collected $20,000 in special fees. So again, that's increasing on the credit side of our revenue account. And then the university also paid fees of $10,000. So since they are paying those out of their revenue account, it is decreasing on the debit side. So overall, that gives us a balance then. So if we were to add this up, we would add 50,000 plus 20,000 is 70,000 minus 10,000 because that was our debit. So we're minusing 10,000. That gives us a balance of 60,000 in our revenue account. Okay? And this is kind of that part of that umbrella picture I was talking to you about. So this revenue account, the revenue, expenses, and withdrawal accounts are actually all going to fall under our capital account. Our capital account is kind of our big umbrella for these temporary accounts. So we have our revenue account here under the credit side. This is where it gets a little confusing. So our revenue is ultimately going to increase our capital account. So we're recording it on the credit side of our capital account. Okay? Don't think too much about this right now because you'll confuse yourself. But just think that ultimately revenue is going to increase our business, so it's going to increase it on the credit side of our capital account. Okay? All right. That might make more sense after we talk about our expense and withdrawal accounts. So when looking at our expense accounts, an expense account is set up to maintain a record of the business's expenses. Here's the debit and credit rule for an expense account. Okay, so this probably looks really similar to an asset account because we're increasing on the debit side and decreasing on the credit side. Okay, so the increase rule, if it's an increase in expenses, we're going to record it on the debit side. A decrease in expenses, record it on the credit side. And the balance is going to be on the debit side because the balance is always recorded on the increase side. Okay, so say we have in our utilities expenses, we have $5,000 that were paid to electricity, $10,000 going towards gas. So that gives us a balance of $15,000 in our expense account. Okay, and this is something that's that students kind of get confused is we're paying electricity $5,000, so shouldn't that be subtracted? But it's an addition to our expense. This is a $5,000 expense that we have, so we're adding up our expenses in our utilities expense account. Okay, so ultimately this is going to take away from our capital account. So that's why ultimately it's under the debit umbrella side of our capital account here. So we have that revenue account over here on our credit side, and we have this expense account over here on the debit side of our capital account. So, because ultimately these expenses are going to decrease the value of our company because we're spending this money. Okay? All right, so let's kind of, back it up here, sorry. Okay, so then we mentioned that these are both temporary accounts. So ultimately, eventually what we're going to do, we're going to transfer this $15,000 balance and this $60,000 balance, and it's going to look like this. Here's that $60,000 balance from our revenue account, increasing on the credit side of our capital account. And then we're also going to transfer that $15,000 balance from our expense account, which is ultimately decreasing our capital account. And so that's going to give our capital account then a balance of $45,000 because we increased it by the $60,000, we subtracted our debit amount of $15,000, giving us a balance, which is recorded here on our increased side, a balance of $45,000 in our capital account because revenue and expenses affect our overall value, monetary value of our business. Okay, so let's look at a different example here. So the starting balance of an owner's equity account is $10,000. So this is the balance that we carried over from last year, and we have a $10,000 balance in our owner's capital account of $10,000. Okay, revenue received from our customer, Mr. John, equals $2,000, and revenue received from Mrs. Jones equals $1,500. So we're going to go to our revenue account and record those increases. So we got $2,000 from Mr. John, $1,500 from Miss Jones, giving us a balance in our revenue account of $3,500. Okay, same business that we're looking at here, but now we're looking at some of their expense accounts. So electricity charges paid equals $500 and salaries paid total $1,000. So we're going to increase our expense account by $500 and then increase our expense account by $1,000, showing that we paid a total of $1,500 in expenses so far. And some of you might be thinking, okay, well, Miss Lamphere, you always talked about if there's a debit, there's always a credit. Where's the credit for these, and where's the debit for the revenue transactions? So right now we're just showing you the effect on these individual accounts. You're correct. Ultimately, we would be recording these. We would also be crediting our cash because we're paying this electricity bill. So we would be crediting our cash account and then debiting our expense account. Same with salaries, crediting our cash account, debiting our expense account. Okay, so there is a debit and credit with each of these transactions still, but right now I'm just showing you the ones that are affecting these certain accounts that we're discussing today. Okay, so we have that $1,500 then transferred from our expense account. Here was our balance at the beginning of the year, was $10,000. Here's the additional revenue that we received from Mr. John and Miss Jones. And then we're going to subtract the balance from our expense account. And that's going to give us a balance then of $12,000. Okay, so we're saying that that was if that was all the transactions for our business from the beginning of the year to the end of the year, this would be our new end of the year balance. So that's a good thing. We're ending out we started with $10,000 and we're ending the year with $12,000. So that's a $2,000 net profit that we had that year after we paid our expenses. Okay? All right. Okay, now let's talk about that third account that we were introducing in this section, the withdrawal account. So a withdrawal account is another temporary account that lists money withdrawn by the owner for his or her personal use. So this is an account that the owner of the business, they're able to just kind of withdraw money for their own personal use. So that comes out of their withdrawal account. The debit and credit rules for the withdrawal account are, it's going to increase on the debit side. So this looks just like our expense account. We're increasing on the debit side and decreasing on the credit side. So set up just like our expense account, and the balance rule is the same as well. It's going to record the balance on the debit side of this account. Okay, so Mr. James made 3 withdrawals from his business of $200, $300, and $500, and then he ended up returning the $200 to the account, or to the business. So what that's going to look like, here's our withdrawal account, our little T account for withdrawals, showing the $200 withdrawal, $300 withdrawal, and $500 withdrawal. Okay, and again, like expenses, we are increasing the amount of money we are withdrawing. So that's why we are recording it on the increase side. And then he returned $200. So that's why it's crediting the account for $200, because that amount was returned to the withdrawal account. So that gives us a balance then of $800 in our withdrawal account. 200 plus 300 is 500, plus 500 is 1,000, minus 200 gives us $800 balance. Okay, so Mr. James' capital account had a balance of $10,000. Now we transfer over the balance from the withdrawal account. So this was our balance at the beginning of the year. This is kind of a new example. So $10,000 at the beginning of the year. When we throw in our withdrawals for the year, debits our overall capital account for $800. So we took that $800 balance on the debit side of our withdrawal account. We're transferring it here to our capital account, and that leaves our capital account with an ending balance of $9,200. Okay? And again, here's that big kind of umbrella view then all together. So we have our owner's capital account, which is our permanent account. And it is affected by these 3 temporary accounts. We have our revenue account, which is set up to increase on the credit side, decrease on the debit side. Then we have our expense and withdrawal accounts. They're going to increase on the debit side and decrease on the credit side. So these 2 accounts, the reason they're over here on the debit side of our capital account is because ultimately our expenses and our withdrawals are going to decrease our overall value. As we pay out expenses and as we pay out withdrawals, that decreases the monetary value of our company. So that's why it's recorded over here on the debit side. Okay, let's do a couple examples, transactions together. So on January 4th, Dimension Software delivered Microsoft Word 2005 to Brito & Sons for $25,000. They received a check from the company for the full amount. Walking through step by step, we're first going to identify the accounts that are affected. So if we received a check for $25,000 from Dimensions for the software package. So we're looking at this as if we are Dimension Software Incorporated. Okay, we're looking at their accounting books right now. So the accounts that are going to be affected for Dimension Software are cash at bank, because they received that $25,000 check, and then sales account, because it's going to be recorded as a sale. They sold this Microsoft Word package to Brito & Sons for $25,000. So let's classify these accounts then. Cash in bank is an asset account. Sales is a revenue account. Okay? That's one of the new accounts we just discussed. So if cash in the bank increases by $25,000, our revenue is also going to increase by $25,000. Look at our debit and credit rule. We're going to debit cash in the bank because we debit assets as they increase. And then we're going to, I must have cut off the credit rule here. So we're going to debit cash in bank because we're going to increase our cash in bank account. Then we're going to credit our revenue account because revenue increases on the credit side. So, here it is here. So again, credit, sales, revenue, we debited cash. So here's what it looks like in those T accounts. Debiting cash for $25,000, crediting sales revenue for $25,000. Got our debit and our credit, we're good. Okay, let's look at this next transaction. On January 16th, Dimension Software Incorporated mailed a check of $500 to Robert for the office rent. So they're renting their office space and they paid their rent for the month. So we're going to use a rent expense account and cash at bank account because we're paying our rent. Okay? So rent expense is an expenses account. Cash in the bank is an asset account. Our expense account is going to increase by $500. Cash in the bank is going to decrease by $500. We're increasing rent because it is an addition. It's a added expense that we have. We're increasing the amount of money that we're paying into rent, and it's going to decrease cash because we're actually paying the $500 out of cash. So we're going to debit our rent expense account because those expense accounts debit are increased on the debit side. Then we're going to credit the cash in bank account because our cash account is decreasing. So here's what it looks like in those T accounts. Here's our rent expense. We're debiting $500, and then our cash in the bank is being credited $500. If you want to go ahead and look at page 16 of section 4, maybe I can drag it over here, talks about testing the equality of debits and credits. So we said how you need to make sure your debits are always equaling your credits. We'll kind of read over this last page here. It kind of just touches on trial balances, and we're going to get into that a lot more, but just some good information for you to be aware of before we move on. So check out that page, and then there's also a quiz on page 14. Not a graded quiz, but just I guess I should call it an activity. So kind of test yourself with this activity to see if you're familiar now with the steps that we take to identify accounts, classify them, determine whether or not they increase and decrease, their debit and credit, and so on. Okay, and then like I said, we'll be talking about this assignment 3 at our next Class Connect session.